Hi, my name is Nabila. My group consists of me, myself, Nabila Huwaina binti Ramli, Ahmad Nasrul Hakimi, and Muhammad Saifullah. Today we are going to present about Islamic derivative market on principle of it, essential instrument, and Sharia perspective. First of all, let me introduce a little bit about the derivative instruments. So basically, derivative instruments in their current forms are relatively new instruments compared to financial assets such as stocks and bonds that have been exchange traded for more than a century. Derivative instruments, especially financial derivatives, are very new. So derivative instruments are financial instruments that derive their value from the value of an underlying asset. The underlying asset could be a primarily financial asset like common stock, bonds, currencies, or commodities. There are two primary purposes of derivative, which are hedging and speculation. Derivatives are used to minimize risk exposure arising from various routine transactions. So business faces interest rate risk, commodity price risk, and foreign exchange risk. The purpose is to reduce or curb the price risk in all transactions that require delivery in future of money, commodity, or security. So the other purpose or use of the derivative is speculations, earning from favorable price movement. Thus, we will discuss further on the derivative elements and essentials in the literature review.
Bismillahirrahmanirrahim, Ustaz. This is Saifullah. This is my part. As for the literature review, as business environment become increasingly sophisticated, new and better financial products were needed to manage the changes. So every newly evolved product must provide increased benefit or add values with the existing product that survive. There are four main instrument in derivative market. First is forward, futures, options, and swap. From an Islamic point of view, the permissibility of derivative market is a topic on which many scholars, Islamic scholars particularly, holds various opinions, with several jurisdiction of approving and prohibiting of such contract. Or Biyatullah Ithmath Bacha conduct a comprehensive review where some of Islamic instruments are similar to derivative. The objective of Islamic scholars regarding derivative may require rethinking and evaluation. He means Ibayatullah elaborates on the instrument by elaborating on the critics' rationale why Islamic communities need this instrument in the marketplace and repercussions for Islamic business if these instruments are disregarded. Another Islamic scholar, Muhammad Ubaidullah, Muhammad Ubaidullah, argues that the futures and options are forbidden from two distinct perspectives, focusing on the definition of saraf. According to the first viewpoint, any gold and silver would be governed by the laws of bay'ah saraf, while fiat and paper currencies do not fall under the bay'atul saraf category. He cited Ibn Taymiyyah definition of saraf as gold and silver that could function as a medium of exchange, where fiat currency is not regarded as saraf or currencies. Since the fiat currencies, since the fiat currency is not classified as saraf, selling and buying fiat currency with other fiat currencies and deferred delivery if the currencies are not composed of gold and silver is permissible.
Okay, for this slide is about to the forward. Forward are contracts where two parties agree to buy or sell a specific quantity or amount of an asset at a specific date in future at the price agreed at the inception of the contract. In forward contracts, parties agree to deliver today without exchange of money on the spot. Assets and payment will be exchanged on an agreed or set date in future, which is also called a settlement date. Buyers are referred to take long positions and sellers are referred to take short positions. Forward contracts, like future contracts, include trading stocks, currency, and commodities, except that they are traded in the over-the-counter market, rather organized market, where the contract can be designed and tailored to the contractor's needs and desires. The forward contract standardized version exchange tradable with standardized quality, quantity, and delivery dates are known as future contracts. In fact, futures are improved and exchange traded version of the forward contracts.
Future contract is a popular financial instrument that used in various industries to hedge risk and speculate the future price. This type of contract involves an agreement between two parties to buy or sell a specific asset at a predetermined price and date in futures based on advertisement write-up. Futures contracts have a long history. Future contracts have a long history dating back in 17th century when farmers in Japan started trading rice futures to hedge against the price fluctuation. In the United States, the first futures exchange was established in Chicago in mid of 1800 uh, to trade our agricultural commodities such as wheat, corn, and soybeans. Over the time, futures contracts have evolved to include various asset classes such as metal, energies, currencies, and indicates. There are two main types of futures contract commodities, and there are two types of futures. First is commodity, and second is financial. Commodity futures involve physical commodities such as wheat, corn, soybeans, crude oil, or gold. Financial futures are contracts that involve financial instruments such as currencies, stocks, bonds, and interest rates. Each type of futures contract has various subcategories that investors can choose from based on their investment objective and risk tolerance. Future contracts can also be used for speculation. Traders can buy or sell futures contract expecting to profit from price movement. If if done correctly, this high risk strategy can lead to significant returns. Another advantage of futures contract is their high liquidity. Futures contract can trade or exchange and can be easily bought and sold. This makes it easy for investor to enter and exit position quickly. Future contracts are versatile finance instrument that can also be used for hedging. They offer benefit as price risk management, high quality, high liquidity, and the potential for high returns. However, they also come with price volatility and counterparty risk. With proper due diligence, future contracts can be valuable to a diversified investment portfolio. Commodity of future contract. Sorry, product of the future contract. First is commodity future contract, such as crude palm oil. Commodity futures contract are agreements between two parties to buy or sell a specific commodity at predetermined price and date in the future. These contracts are standardized and traded on exchange, such as Chicago uh, Mercantile Exchange (CME) and ICE. The price of commodity futures contract is determined by the supply and demand factors in the market. Commodity futures contract for crude oils offer several benefits. First is transparent and efficient price. Second is hedging and leverage. Second is for the financial product is composite index. A financial future contract is binding agreement between two parties to buy or sell specified asset at predetermined price and date in the future. These contracts are often used to manage risk associated with price fluctuation and volatility of the underlying asset. Financial futures contracts are traded on futures exchange regulated by the financial authorities. Composite index is a weight index several stocks, often representing a large portion of a specific market. Some of the well-known composite index include S&P 500, Nasdaq Composite, and Dow Jones.
In derivative markets, options are the third and most developed tool for hedging and speculation. In the case of future contracts, either delivery or liquidation must take place. But in the case of option contracts, the investors has the rights but not the duty to buy or sell the underlying assets in the exchange for the payment of a premium. The right to purchase something is referred to as call options, whereas the right to sell something is referred to as a put options. If a call or put option is profitable for the holder of the options to exercise, then the option is said to be in the money. If an option is not profitable, then it is not considered to be in the money. So there are two solutions. The solution to this was the innovation and development of option contracts. All exchange traded options come in two types, which are call options and put options. A call option entitles the holder the right but not obligation to buy the underlying asset at a determined exercise price or any time before maturity. So a put options, on the other hand, entitles the holder the right but not obligation to sell the underlying asset at a predetermined exercise price at or before maturity. So there are two types of options. We are call options, which is the buyer has the options to buy an item at the strike price, and the second one is the put options, which is a buyer has the option to sell an item at the strike price. So, and the two covered and naked options. The first one is covered options. Writer either own the security involved in the contract or has limited his or her risk with other contracts. And the second one is the naked options. Writer does not have or has not made provisions to limit the extent of risk. So since option provide the right but impose no obligation, the holder only exercise if it is favorable for him to do so. So this obligation to exercise provide increased flexibility and is key advantage of option over forward or futures. The buyer of forward pays for this privilege by paying the seller a non-refundable premium. A swap contract is a type of Islamic derivative instrument in which two parties agree to switch a cash flow or asset based on a formula or benchmark that has already been set. In Islamic banking, profit rates swaps, currency swaps, and commodity swaps are all kinds of swap contracts. Swaps are another tool usually linked with interest rate hedging, where parties agree to exchange a series of cash flow. For example, variable rates payments with fixed rate payments. So in an Islamic profit rate swap, two parties agree to trade profit payment based on the rate, a standard rate, such as profit rate of an Islamic bond, which is sukuk, or an Islamic financing facility, mudarabah or musyarakah. So the Goal of the swap is to control risk and to protect against changes in the profit rates.
Next, for this part is the advantages of using derivative in Islamic investments. Derivative provide security or stability in deals when the prices of securities or assets are about to go down. If a derivative unused, investors in Sharia goods and services won't be safe. Next, Islamic financial markets can be competitive and attractive to investors if they don't have the right risk management tools. Risk caused by market flaws will continue to be a problem. Once the right tools for managing risk are in place, the number and size of investors in Islamic capital markets are likely to grow. Islamic capital markets will grow and fight with traditional ones, both in their own countries and around the world. The next point is the disadvantages of using derivative in Islamic investments. First, derivatives have a complicated structure and require full knowledge and understanding, which is not every user may have. Using derivative alone does not always protect against risks. Next point is the Islam doesn't allow money to be made from jahal or from not knowing what the other person wants. Swaps are needed to deal with the risks and that they come from the market flaws. Considering how the derivative work, there will always be a chance for getting lucky and making money. This is because uncertainty comes from the world economic system or theory, so the Islamic capital market has to work with this in mind. So the last point for disadvantages, people will keep guessing, which will make the market even less stable. In a derivative, one side takes on the risks, so there are clear winners and losers. This goes against the basic principles of Islamic economies. And then this slide we present about the forward contract and Sharia perspective. Forward contracts are the permissible under the principle of Sharia if they adapt to the contract of salam. Salam, as defined by jurists, is the sale of a commodity whose delivery will occur at a future date for a cash price. That is, it is a financial transaction in which the price is agreed upon in advance and payment is made in cash to the seller, who abides by the delivery of a specified commodity by a selected date. The commodity sold and described on liability is deferred, while the price is immediate. The salam seller will engage in a salam sale with the bank in which the bank will pay cash and the salam seller will deliver the commodities to the bank or buyer in the future. The bank will enter into a second salam agreement with a buyer of the commodities, requiring the buyer to pay cash during the contract if the commodities are to be delivered in the future or through deferred payment if the commodities are already in possession of the bankers.
Futures in the Islamic perspective, Islamic ulama or the
Next
Islamic
is the
scholars
management of
oppose
risk in
the
Sharia
futures for two
perspective.
primary
Management of
reasons
risk
in
is
an
becoming an
interview
increasingly
with
important component for both
Ghazal
conventional
Farul
and
Adil
Islamic
conducted
financial
in
institutions. So
1999.
in this
The
regards, it
prominent
is
Islamic scholar
significant
Mufti Taqi
components
Usmani
whether
prohibits using
Islamic or
futures.
non-Islamic.
The reason
However,
that
from the
delivery of
perspective of
the
Sharia,
reason
there
of
is
this
no problem
prohibition
with that,
is
and
the
we
delivery of goods
also
and
encourage
fund will
people to
occur in the
use further
future rather than
actions
during the
when
contract
carrying
period.
out
Therefore,
activities. So
it
it
is
is
not
to highlight the
Islamically permissible
significance of
spot
risk
exchange,
management function
deferred payment, and
within the
salam
same context.
as the
This
contract of
is
sales.
due to the fact that the presence of
In
an
Sharia
excessive
perspective of
risk
options, a more
can be
complex
seen as
financial
gharar.
derivative
So
instruments,
the
the
risk
buyer and vendor
reduction is
can
also
withdraw
in
from
line
the
with the
sale and
goals of
purchase
Maqasid
agreement.
Sharia,
Mufti
which is
Taqi
another
Usmani
name
prohibits
for the
options
Islamic
based on
legal
the
code.
fee charged for the promise, not because of the promise. According to the Sharia law, the pledge of permissible for both call and put options. It is promised by one party to acquire or sell the property of another at the future dates. So the issue with option is that the premium fee imposed on the promise renders the contract invalid. So in addition, it did not propose an alternative contract to options. And a swap contract is a deal between two parties to trade cash flow in the future based on the formula that has already been set. The swap deal can be based on the different things like interest rates, currencies, or commodities. From the point of view for Sharia, a swap deal can be okay if certain conditions are met. The principles of Islamic banking stress the idea of risk sharing or forbid transactions that involve riba, which is another words of interest, based for a swap deal to be in line with Sharia, it must meet the following requirements. So what requirements must meet to comply with the Sharia? For the first one is the underlying asset must be okay. For example, a cash swap is allowed if both currencies are halal or allowed according to Islamic law. And the second one is the values of the exchange must be same at the time the deal is signed. So this is because the Prophet Muhammad said it was wrong to trade things to different quantities. So the other one is the cash flow can't be planned ahead of time, and they have to count on something that can't be known for sure. This is because Islam forbids gambling, and in order to avoid it, deals must have an element of uncertainty. Yeah.
So for this part is the discussion, and the first of the discussion is the standardization in Islamic derivative market. So one of the primary challenges facing the Islamic derivative market is the need for more standardization. Unlike conventional derivatives, which are based on standardized contracts, Islamic derivatives are based on customized contracts tailored to each transaction. This lack of standardization makes it difficult for investors to compare different investment products and create uncertainty about the terms and condition of each transaction. So for this part is the liquidity in Islamic derivative market. Another significant challenge facing the Islamic derivative market is limited liquidity. Unlike conventional derivatives, which are traded on established exchanges, Islamic derivatives are traded over the counter (OTC). This lack of a centralized marketplace makes it challenging for investors to buy and sell Islamic derivatives, leading to the limited liquidity in the market. Market players need to establish a centralized exchange for trading Islamic derivatives to address the issue. This will increase liquidity in the market and make it easier for investors to buy and sell Islamic derivatives. Um, Regulatory hurdles are also a significant challenge facing the Islamic derivative markets. Many countries lack regulatory frameworks that specifically address Islamic derivative, which creates uncertainty for investors and inhibits market growth. To address this issue, regulators need to establish a clear guidelines for issue the and trading Islamic derivative. This will provide investors with make greater certainty and help to promote the growth of the market. Next is the awareness of investors. A lack of awareness is another challenge facing the Islamic derivative markets. Many investors are unfamiliar with Islamic finance and do not understand the principle behind Islamic derivative. This creates a barrier to entry for investors and limits the market growth. To solve this challenge, industry players need to work together to promote greater awareness of Islamic finance and its principles. This can be done through educational programs and marketing campaigns highlighting the Islamic finance benefits and compatibility with Sharia law. The Islamic derivative market has significant potential for growth and offers investors a range of investment products that conform to Islamic principles. However, as with any emerging market, it faces several challenges that must be addressed to ensure its continued success. By addressing issues such as lack of standardization, limited liquidity, regulatory hurdles, lack of awareness, and volatility, the Islamic derivative market can continue to grow and offer investors new opportunities to invest in compliance with Sharia law.
Next is the management of risk in Sharia perspective. Management of risk is becoming an increasingly important component for both conventional and Islamic financial institutions. So in this regards, it is significant components whether Islamic or non-Islamic. However, from the perspective of Sharia, there is no problem with that, and we also encourage people to use further actions when carrying out activities. So it is to highlight the significance of risk management function within the same context. This is due to the fact that the presence of an excessive risk can be seen as gharar. So the risk reduction is also in line with the goals of Maqasid Sharia, which is another name for the Islamic legal code. On the whole, the evaluation of Sharia compliance for derivative instruments has been inconsistent. Sharia scholars have not reached consensus on the interpretation of derivative due to complexities involved. Even among experts who adhere to the same mazhab, there is no agreement over whether or not derivative can be used in Islamic finance. This is the case despite the fact that many mazhab provide guidance on the interpretation of these instruments. In this part, the problem that are associated with modern Islamic derivative card and products are being investigated. So most of investors are aware of these controversies that surround the underlying contracts or Sharia compliance of derivative products. And most investors also agree that wa'ad contract creates difficulties when trying to structure derivative. So wa'ad contract as one in which one party makes a future promise to carry out a duty, such as making a payment or making a purchase. So in this field of fiqh mu'amalat, wa'ad is defined as an expression of intent to purchase a good or services.
So the last part of the presentation is a conclusion for the presentation. The Islamic derivative market has potential for growth, but must address issues such as lack of standardization, limited liquidity, regulatory hurdles, lack of awareness, and volatility. Risk management in Sharia perspective is important as excessive risk can be seen as gharar. Sharia favors the protection of wealth from many forms of risk, and asset protection is an essential component of Maqasid al-Sharia. What contracts create difficulties when structuring derivative as they should not contain commitments that are binding on both parties, resulting in Sharia concerns.